There have been quite a few new things in May. We have a new pope, we have a new German government, and we have a new deal between the US and China. And the latter one, that was probably the one who led to the rally, particularly on equity markets, that took place since mid-May and let us see some new highs in global financial markets on the equity side this month. Now, how do we proceed with this new deal? Is this the beginning of the end of the trade war? Is everything going back again? Everything is good? We don't think so. However, we do not think there will be another escalation in the offing. Although the current pause in the reciprocal tariffs between the US and many countries is likely to end in the beginning of July, there will be probably some extension of these tariffs not being implemented. We do not think that there will be a huge wave of deals. So far we have only seen, apart from this China deal, a deal with the UK, which is okay-ish, but it's not a big deal, and therefore it remains a very difficult environment. Now looking what the markets and the economy is doing out of this, it is mixed. In the US, surveys suggest that the economy is not likely to tank because of the burden of tariffs, which is still way higher than it used to be before, but they're likely to go through, at least for the time being. And we should have in mind that the data, the hard data, what we get on inflation, on economic activity in the next couple of months will be very volatile because there are so many special effects coming through that we can't have a clear picture what actually happened. Now, the US so far on the economic side seems to prevent a sharp recession, but there's still a slowdown likely to take place. In the rest of the world, particularly in Europe, the environment remains mixed. There have been some positive signs from the manufacturing side, but the service sector, what is not directly affected by the tariffs, is in a bad shape. So in this environment, the ECB is likely to cut rates again in June, particularly as there is no immediate high inflationary pressure. But we are still skeptical that they will go on with further rate cuts after that. Now, looking forward, we think that we have seen as well in the month of May is the question about debt sustainability again. So we've seen the downgrade of Moody's on the US, and now the big beautiful bill has made its way through the House of Representatives and is likely to be passed, probably with some amendments, by the Senate by July the 4th. Now, what does this bill mean? We will have some further tax cuts that is likely to be positive for companies and the economy overall, but we have also higher debt. And this is likely to continue the doubts about particularly international investors about debt sustainability in the US. And this is likely to lead to a further increase in US Treasury yields. And this probably will also cause some more upside pressure on yields in other parts of the world. Now, other parts of the world also look at the ongoing conflicts on the geopolitical side. So the war between Russia and Ukraine is far from being ended, and there are more tensions in the Middle East coming up. And there is also, and that's more on the positive side here, the hope that in Germany in particularly, Europe is going to act and it's going to bring things forward. So after the first rounds of the introduction of the members of the cabinet, we now expect some action in terms of proposals, how Germany can bring this huge amount of fiscal space into work. And therefore, we expect at least some guidelines how they want to go ahead in actually doing this. And this might give us some hope how Germany is coming back on track in terms of an economic recovery. But best case, this is likely to take first steps in the second half of this year, and then is more likely to unfold in 2026.